Okay, welcome everyone. Good evening. Thanks for joining us at, I think this would be about our 6th Q&A session, but our first one down here in person in Victoria. So welcome to our locals that get to come and see us in person, and welcome also, so just so everyone's aware, we've got about 100 people joining us online from home, so welcome to those people at home. Tonight we'll be hearing from Colin Keane from Research 4. My name's Andrew, General Manager of CFMG Capital. I've been working in the greenfield land space for about 20 years now, and in that time, Colin's been doing initially in the first sort of 4 or 5 years of it, just doing the Victorian-based land survey, but now since 2007, he's been doing a national greenfield land survey. So it's the longest running greenfield land survey in the country, and I've certainly been a keen observer of it during my career. And Colin will be giving us a pretty good detailed insights into the greenfield land market, coincidentally the market that we operate in. Each Q&A session has got a different theme, so for those of you who've tuned in before, we've done some about self-managed super funds, investment markets in general, and a various range of topics, but tonight, the topic is something very specific to how we operate and what we do. So welcome, Colin.
Thanks, Andrew. Well, thank you for coming along tonight. As Andrew said, my business is monitoring the residential land subdivisions around the country. So all I look at is land that is being sold by developers to either builders or mum and dads. The research that we do is independent. It covers Perth, Queensland, Sydney, Melbourne, Adelaide and Canberra. What I'm going to present today is to give you an understanding as to the performance of the land market, in particular Queensland. And this presentation isn't investment advice, it's just presenting the findings from our work, which we've been doing for 15 years. What I want to look at first is the national land position. In terms of how many blocks of land are sold by developers each month across Perth, Southeast Queensland, Sydney, Melbourne, Adelaide and Canberra. And what you're looking at there is the number of lots sold by all of those markets every month. So for example, the market in December or June 2021 sold 7,260 blocks of land from developers to mum and dads to build their brand new homes. And that represented the high point in the property market. So that was the middle of COVID, and that's the highest the market has ever performed. You'd have to go back to around 2015 before the market, that was when the market recorded 5,000, and then it went into a cyclical downturn in 2019 where volumes only sold 2,200. And if you remember in 2019, that was the Royal Commission into bank lending, and there was a tightening of all those finances. As a result, people didn't buy as much. Coming into COVID, the market was improving, and then all of a sudden COVID hit, and with COVID came a tsunami of new customers into the market. And I'll explain why they came into the market, but they did. But after COVID finished at the end of towards 2022, the market has been in decline, and we're currently sitting at the bottom of the cycle at 2,200 lot sales per month. And this is the first quarter, the June quarter, where volumes have actually improved across every market in Australia, but it's off a very low base. Now, the reason why we've gone really high and really low is because the federal government and the state governments overstimulated demand by giving people additional money, bringing people home from overseas due to the border lockdowns, stopping people from leaving Australia. So all of those extra people in the market decided to transact in the market at that time. And now what we're seeing is a correction return to normal levels. In terms of where all the activity is occurring, Melbourne is the #1 market for land sales. So Melbourne, since 2008 through to now, has accounted for about 35% of the national activity. So of all land sold since 2008 to now, Melbourne has represented 35%. In the June quarter, the last quarter that we've gone through, its share has only been 27%. And you can see South East Queensland's long-running share is 21% of the national pie, and more recently that's improved to 23%. And the market at the moment which is gaining the most popularity is Perth, but that might be just a flash in the pan. In terms of confidence, this graph is the number of cancellations in the market. So if the market sold 1,000 blocks of land from developers to end users, 24% would represent that 240 of those 1,000 lot sales were given back by customers. In other words, 24% of all activity in the June quarter was given back to land developers. The higher the percentage, the worse the confidence in the market about whether to buy or can they buy. So some people find out that they don't have enough money to purchase, so they have to give back their deposit. The thing about it is that the market traditionally goes in cycles. So in 2019, that was the last down period in the cycle, and the return rate was 27%. So confidence from builders and end users wasn't very strong. What we're seeing now for the first time across the country is a drop in the return rate, which means that confidence is now likely to improve over the rest of 2023 and into 2024. In terms of pricing, this is the average price for a block of land. So in Sydney, you can see the average price for a block of land in Sydney, including the Lower Hunter and the Illawarra, is $630,000. You can see why it's very hard for people in Sydney to get into the housing market, and that's why Queensland does quite well from people leaving Sydney. In some particular submarkets in Sydney, around Box Hill and the northwestern suburbs, you would be paying around about $800,000 for an average block of land. So compare that to Melbourne at $390,000, South East Queensland at $372,000, and Perth at the bottom at $240,000. What we've seen with Queensland is its pricing has now come up to be quite close to Melbourne's pricing, which it traditionally has never been, which is another reason why the reason why the prices have gone up is because a lot more people have gone into the Queensland market. In terms of South East Queensland, this is the sub-markets which we kind of monitor, where all the land sales that we collect come from. What it means is that the Logan market is the #1 market at the moment for land volumes. So the number of lots sold by developers is highest in Logan, and then Ipswich and Moreton Bay second and third, the Sunshine Coast fourth, and the Gold Coast fifth. That is volume of activity. And there's a reason why some markets do better and some markets struggle to sell. We'll get to that. In terms of Queensland land sales, so this is the market cycle for land sales from land developers to mum and dads per month. So in the June quarter that just came, or just passed, the whole of the South East Queensland market, that developers sold on average 505 lots per month for the June quarter, compared to middle of COVID at 1,800 lots per month. That line there that you can see represents the average, long-term average of around 740 lot sales per month. So South East Queensland normally does 740 on a long-term average. We're currently at the bottom of the cycle, and we should start to see some improvement in land sale volumes going forward. Why is the market at the bottom? The market is at the bottom for a number of reasons. One reason is that the land development industry has not been able to produce enough land to sell. So therefore people can't buy. The second reason why land sale volumes are down is because people have been uncertain about their financial situation. Can they buy? And the third one is that land developers are so overwhelmed by having sold 1,800 per month that they're still trying to finish the civil engineering to build them. If you looked at each sub-market, this is land sale volumes for each of the markets. So Moreton Bay represents around 19% of all land sales in the market. It's currently under its long-term average, but is improving. So it should be selling around about 170 lots per month, and it's currently selling 130. But it's returning, you can see the sheer volume of people that actually bought in that market, it's corrected, and now it's up, improving again. The Ipswich market and the Logan market are jointly equal. So they're around about 19% of activity, and the Logan Greenfield market is around 22%. The Logan market is southeast Queensland big W of land subdivision. So that's where most of the volume is located, in the Logan submarket. And the benefit of the Logan submarket is that it's closer to the Gold Coast. And the Gold Coast has no land supply. And as a result, I'll show you, you can see the Gold Coast in the bottom. Land sale volumes have traditionally averaged around 100, but when they had land supply, it would be as high as around 250 blocks per month. You can see at the moment they are only selling 26 lots per month. And the reason why is the Gold Coast has no land supply, or very little. So the customers who would normally go to the Gold Coast have to look somewhere else. So one of those other markets is the Logan market. You can see the other two markets there. Brisbane is also struggling with land supply, and the Redland market is just a very small market, just starting to come into its own. In terms of how many blocks of land are needed to be sold in southeast Queensland to meet demand, the number of blocks of land which need to be sold is dependent on the population change, so how many people are coming or leaving from a market. And without going into it in too much detail, there are four main sources of population growth. The first one is new residents. So people who weren't Australian citizens or Australian residents, and they've been given a golden ticket, and they say you are now a resident and a citizen of Australia. And you can see here, this graph in the orange is showing you the number of houses needed to satisfy new residents each month. And the blue line is the actual land sales. And this is for southeast Queensland. What we're seeing with the number of new residents, COVID slowed that up a little bit, but the federal government is trying to increase the number of new residents that come into Australia. So that's going to have a positive impact on housing demand in southeast Queensland around about 2024, 2025, in this period here. So if the federal government actually can physically process that many people. The second one is temporary visas, like students, long-term visitors. And when the borders shut, you can see in the orange line that no one could actually fly into Australia. So no one actually came into Queensland, or not many people came into Queensland who were students or temporary visa holders. As a result, there was no real housing demand generated from this group of people. What we're seeing at the moment is the number of people coming into that market is increasing, and that will place pressure on the rental market and the investment market as these people come back in. The next one is net interstate migration. So one of the biggest drivers of demand for housing in southeast Queensland has been people moving from Melbourne and people moving from Sydney. In Sydney because they can't afford it, Melbourne because Dan Andrews lives here. So we're all out of here now. So as a result, sorry for this, I haven't got a pointer, but you can see the orange line going straight up. They're the number of houses required per month because of people leaving from Sydney and Melbourne. The forecast is to come back to normal. So I've estimated that the net interstate migration numbers will moderate over the coming years back to a normal level. But that's a worst case scenario. It could remain as high as it has been for the last 2 years. A big positive for SEQ. The next one is natural population, people dying and people being born. And this is normally an insignificant thing because the death rate and the birth rates are pretty normal. But since September 2021, there's been a 30% reduction in the growth of the natural population base. And that occurred in September 21, and as a result, you see this orange line drop. That's because extra people died that they weren't expecting, and not many people had children, or less people had children. I'm expecting that to be a blip, not a pattern. And the one which impacted the property market the most over the past 2 years is what I call the Anzacs. Now the Anzacs are Australian citizens and Australian residents who normally live outside the country. So leading into COVID, there were a lot of people living outside in other parts of the world. And when we shut the borders, all those people came back. Those people came back, causing this orange line to go up. And they came back within a 6-month period. About 700,000 Australian citizens came back. At the same time, about 80,000 Australian citizens were stopped from leaving the country. So you had this tsunami of people coming in, and a lot of people who would normally leave stay put. And the only thing you do in Australia when you can't leave it is you buy houses. And so what happened here, you can see the land sales go through the roof at the same time as this happened. The federal government, what do the federal and state governments do when they're in a crisis? They give out first home buyer grants. They give out stimulus packages, regional grants, stamp duty savings. They went to town. And they stimulated the market so much, thinking that no one was here, but everyone was here. They all came home. And they said, oh, well, I'm sick of watching telly. Let's buy a block. Let's buy a house. So what happened is you brought forward a lot of demand from the future into the present. And that's why you have this correction. That's why at the beginning you saw land sales fall. It's because we brought forward a lot of customers who never have bought in the housing market in 2021. But now we're starting to get that out of our system and return back to average, right?
Excuse me, can I just ask, what's NOM stand for?
Net overseas migration. Yep.
Is this purely just for the land sales or for resales as well?
Just the blue line. The blue line is primary land sales.
Primary.
Yep.
Just land sales.
Primary land sales.
Sorry, let me just step in now. I had one job to start, which I forgot. So as these guys have shown, if you've got questions, feel free to ask them. Same with those people online. So yeah, just jump in and ask questions as we go. Thanks.
That's all right. So yes, the blue line is primary land sales from land developers, not resales. Yep. So when you add all of those population movements together, you get a demand number. Like you get actual land sales in the blue, the spike, and this is what it should have sold, according to me, based on population change.
Colin, how much of these average demand figures have been skewed by the spike during the COVID years? If we took out those spikes,
Yep.
then what would happen to the averages, do you think?
Yes, if you took out the averages, if you took out the spike, you'd probably be looking at around about 700 and 800 lot sales per month as a long-running average demand figure. So that orange line there probably gives you the average demand over that period. This here, this one. So that's the average of that orange line from here to 2008.
Be lower if you excluded COVID, which is somewhat unusual.
Yep.
Then it'd be a bit lower than that.
If COVID didn't happen, you would have lower sale volumes, but they would be still in the top part of the market cycle. Because out of 2019, we were improving the market post-Royal Commission, and the market was gaining momentum. All the governments did was put a lot more people into the market with a lot more money and created this environment where you can see here. That government stimulus overwhelmed the development industry, which then had difficulties in producing the land on time and on budget. For example, in Melbourne, people who bought land 2.5 to 3 years ago are still waiting to build on their block of land. And that's inflationary. It's just a government stimulus issue. But if COVID never happened, we would have had a really nice market like this. That would have been like that. In terms of competition, so we have, sorry, I'll go back. When we're going forward, we're expecting that land sales, the demand for land, we're at the bottom of the cycle. We're expecting that demand for land will improve across SEQ with that orange line, in line with all the population drivers which I've explained. The average demand going forward over the next 2 years is 720 per month. And the long-term forecast more about 830 per month, which is good for Queensland.
But this says Melbourne.
Oh, that's just a title, sorry. Sorry, that is Queensland.
867.
Yeah, sorry about that. The number of projects operating. So in a residential land market, the value of land is influenced by how many developers are operating in the market. If you have more developers operating in the market, then there's more competition. And therefore, if there's more competition, it can actually place pressure on pricing. So what you can see with this graph here is you've got projects, number of residential land projects. 250 was the highest. And during COVID, we've run out of projects and we're now currently at 156 land projects across southeast Queensland. Why that went from 250 to 150 is because we were selling so much land, all the developers came to an end quicker. All the land estates finished up quicker. What we're expecting to see going forward is the number of projects to increase, possibly out to about 2026 before they actually start to reduce. And the reason why the projects will start to reduce after 2026, the number of projects, is because land supply across southeast Queensland is very limited. So developers need land supply to build on. If they can't get the land supply, then you can't build the projects. So land supply is... And what we can see here, this is land supply. So there's 156 residential land estates across southeast Queensland. There they are. Within those 156 estates, there's about 90,000 blocks of land remaining. Outside of those land estates, there's another 85,000 blocks of land in future land supply, which can address 17 years of customer demand. So there's enough land to address demand of around about 17 years of activity. The question is, how many projects are likely to, out of that future supply of 85,000, we have 280 future projects. And once those 280 projects come into the market, then we have a drop in competition. Those 280 projects will be delivered into the market over a 4-year period. The bottom line is that residential competition between land estates will get very tight at around 2026 because land supply will have got very limited, become very limited. I'll give that one a miss. In terms of pricing, the price of a block of land, a rule of thumb, is dependent on the price of a house. The price of a house determines the price of land. In southeast Queensland, a price of the land should be around 47% of the median Brisbane house price. If it's above that, it's overvalued. If it's below that, it's undervalued. So at the moment, we're just sitting above it, which is pretty much on balance. So the price of a block of land in southeast Queensland is not overvalued, nor is it undervalued at this present stage. It's currently at $368,000, which is around about 47% of the Brisbane house price, and the Brisbane house price is about $750,000. You can see Brisbane house price go up, as a result, land prices go up. If house prices go down, the land price should go down. House prices determine land prices. So if you want to know if land prices are going to go up, you just keep an eye on the Brisbane house price. In terms of other markets, in Queensland, land to house ratio is 47%, in Sydney 45%, Melbourne 44%, land 44% of the Melbourne house price, and you can see it's quite uniform around the country. Adelaide has the cheapest. My last couple of slides. Sunshine Coast here. You'll get a copy of this presentation so you can read it in more detail. Basically, these charts have the land price in the green, and this is the annualised price movement of land. So in the Sunshine Coast, for example, the current price is $482,000. Over the past year, it went up 5%. The 7-year annual rate is 2.4% annualised growth. The land to house ratio in Sunshine Coast should be 54%. It's currently 62%, so it's a bit high. So that price of $482,000 should be closer to $386,000 in the Sunshine Coast. But the Sunshine Coast is influenced by coastal property versus non-coastal property. But as a rule of thumb, land in the Sunshine Coast at the moment is probably overvalued.
But then your Sunshine Coast is averaged based on the whole area.
Correct.
Right?
Yes. Yep. If you looked at Moreton Bay is another market which is kind of separated between closer to the water and west of the freeway. So it's 387,000. Annualised growth over the past year has been at 1%. 7-year annual is 3.1. You can see a lot of the price growth has been over COVID. Fair value for land in Moreton Bay is closer to 410,000. So currently 387, could be 410. It's undervalued relative to the Brisbane house price. Ipswich, once again, same pattern of behaviour. All the price growth has been during COVID. 341,000, 1% annual growth over the past year, 2.5% annualised average. Should be around 40% of the Brisbane house price. It is 44%. The ideal price for land in the Ipswich market as an average is about 307,000. Once again, if Brisbane house prices go up, then that will allow land prices to go up as well. The Ipswich market is a long market between Springfield Lakes, going out to Providence and Ripley Valley, so there's a lot of variation in that. For example, the Land Lease project did really well. They're selling in the 400,000s and they're doing like 25 to 35 lots per month, which is an exceptional sale rate. The Logan market, current price, the average price of land is 323,000. It's grown by 3% over the past year. The annualised rate is 1.8%. So you can see price movement since 2008 has been 1.8. Its ideal price point for land in Logan is $305,000 for a block of land. That's the ideal price relative to the house price in Brisbane at the moment. So, in summary, hope that hasn't been too confusing. What we're seeing in the greenfield residential market is we have just come out of a massive spike in demand. Every market experienced a significant upswing in sale volumes during COVID. That was deliberate, that was brought about by the federal and state governments overstimulating demand. We have now seen a correction in that activity and it's come to the bottom of the cycle. Every market has done the same thing. Queensland, Melbourne, Perth, Adelaide, Geelong, Canberra, all the same thing. Which just proves that what drove that spike is a national phenomenon. And now we've come out of that. And we are now at the bottom of the cycle and we are moving towards average again. Right? The speed of which we move to average will be determined by the economic setting now. Whether interest rates remain stable, whether affordability remains viable. But that put to one side, people still need the housing. So someone's going to have to come to the party and put the house on the ground. And that's why we have a rental problem, because we don't have enough activity because of this affordability thing. The SEQ market has good positive indicators for the future because of net interstate migration. It hasn't sold too much into the future. It has good competition levels between the land estates and the supply line is relatively tight. The Logan and the Ipswich market will be volume best value markets. The Gold Coast will move to medium density because it can't get the supply. Moreton Bay is your premium market with a bit of both. So in a nutshell, that's the national greenfield market. So I hope that's been useful. Thank you.
Can I just ask, when you talk about lots, are we all talking, they're the same size?
No, they're all different sizes. So they'll range in the residential product mix starts from anywhere from 100 square metres, a townhouse block, through to a 2,000 square metre block. So most of the product, I mean 98% of all the product that we capture is probably less than 1,000 square metres in size. So I'm not talking about acreage, I'm not talking about 2,000, 3,000 square metre blocks, residential blocks, yeah. The average block of land, I think in the southeast Queensland is around 400 and 425 square metres. In Melbourne it's 375, in Perth it's 325.
Oh, Perth is smaller.
Yeah.
I thought Perth would be double.
Yeah. So what you're seeing in the market at the moment, because of the affordability to get the price down, you're seeing a lot of developers sell smaller product. So in Melbourne, for example, there have been developers who've been selling 175 square metre plot pieces of land as townhouse product. And that's just to get the price point down so that people can get the money from the banks at this junction.
Sorry, I have one quick question as well. Not questioning the authenticity of the data, but how do you determine the immigrants going into which part of the state in the country? How do you know how many coming into Melbourne versus how many going into Brisbane versus how many going into Perth, for example?
Yeah. The question is, how do we know the distribution of population movement?
Yeah.
The ABS.
ABS.
Yeah.
Sure.
So the ABS publish the numbers about which state people go into. Yeah.
I've got a question. In one of the slides you were talking about future projects or something.
Yep.
Is that those future projects, are they like shopping centres, infrastructure, or?
Are they?
Yeah. Like, there was some statistics there on something.
I think you're referring to land estate, land projects.
Yeah, here we go. Yeah, future estates, and then.
Yeah.
Mentioned something about. Yeah.
Well, when the
Future estate, okay, so
Yep.
land.
Yeah, the question is about future estates, and future estates are residential land subdivisions. Yep.
So Colin,
Yes.
with the advent of people now working from home rather than commuting into a central area to work, what effect has that had on the types of developments that are being offered further out?
The question is the impact of working from home on the type and style of land developments?
Or the amount?
The amount. What we saw at the latter end of COVID is a huge rush into regional areas. So the direct effect of people working from home during that period was we saw an astronomical lift in demand for peri-urban subdivisions. So we saw a lot of subdivisions occurring outside the normal areas. Right?
Is that trend continuing?
That trend is moderating, similar to in terms of volume. I think regional markets are going to have a legacy, a positive legacy from this, but it's not going to be to the degree in which it was during COVID. And you can see the kickback already now from corporations wanting people to work in the office, but that won't happen that won't go back to normal, I don't think. I think there will always be a residual.
I can add to that. Certainly in Queensland, in my 20 years in the game, back when we first sort of marketed projects, quite a common selling point would be your proximity to the CBD. You'd always say X amount of kilometres to CBD, X amount of minutes to CBD. These days, most people buying in these sort of fringe urban areas, they're not commuting to the CBD. The relevance of how close to the CBD they are it's of no consequence to those buyers. They're generally, places like Springfield, Logan, outer suburbs like that. They're creating new cities, new infrastructure. Everyone lives, works, gets educated in those locations. There's no reason for them to go into the CBD. There'd be people in Brisbane that haven't been to the CBD in years and got no reason to go there.
Yep.
Yeah, Colin, we watched some headlines recently about in Victoria the government's going to advertise sort of slowing down greenfield releases and moving more into sort of infield brownfield development, and which sort of, you mentioned a slowdown, which is sort of 18 years away. Is that do you think Queensland government will follow something that will bring that sort of more forward, and is that something that will impact?
Yeah, so the question is, will a government policy on slowing greenfield activity impact the SEQ market? Will they adopt a similar policy? Can't really answer that confidently, but I can give you an indication that all governments are Labor governments at the moment, and I would say that they all communicate with one another. And the second thing is they associate greenfield development as a tax or as an expensive thing for government. That's why Andrews doesn't want it, because he's run out of money. But the general market want it. So in the past, when these policies have been floated, they haven't actually gained any traction, because to stop or slow greenfield development, you have to replace it with something else. And you cannot replace that level of activity with infill. The number of developers, the land supply is more problematic. But to answer your question, I would think that the Labor government will be thinking about it. But whether they could actually do anything about it is another thing. Yep.
I've got a question. One of your earlier slides, the confidence or the handback rate.
Yep.
Looking at that slide right back when you're at it, would it be fair to say that the confidence or the lack of confidence matches with either tightening in lending policy or rate rises historically?
Yeah, correct. So there's been really 3 periods when confidence level, so when you see that line above this line here, there's a lack of confidence in the market. When you see it below, there's strong confidence. And what I mean by strong confidence is that builders will go, I will take as much land as I can get from a developer to build houses, and mums and dads will go, I'll buy. When it's above this line, what happens is the builders say, I'm not sure whether I need 10 blocks of land or 5. And they give some back. And mums and dads might go, like in WA, for example, you can put down a hold on a block of land for $200. Just hold it. And what they do, the customers go around and go, hold. and then they go home, have a cup of tea, and look at which one's the best. They go, I'll take that one, and then they go back and say, you can have that back. That's a return rate. So the market generally, this period of lack of confidence is a lack of liquidity from the banks during the Lending Royal Commission, because it was taking 9 months to process a loan. This period actually is an affordability trigger. So the lack of confidence or the high return rate is being driven, in my opinion, by uncertainty around how much they can actually borrow, and the builders are in troubles in terms of fixed contract prices. So their cost of construction is uncertain as well. So the builders are trying to juggle their costs, and the mums and dads are trying to juggle their budgets with the bank. As a result, you're getting a lot of product being turned around. The thing is that it generally doesn't stay up here for long, because what it means is people react and they get it out of their system, and then they make a more considered decision the next time they go to the market. So the next time people come into the market, they'll know their budget, and the builders will have a better understanding of their cost, hopefully.
Got a question from the online audience. To clarify, does land supply equate to approved land by state or local government areas to develop on? What's the rate government approves new residential areas in southeast Queensland for land development?
Yep.
And also, and they've added to that, what proportion of land in southeast Queensland would be deemed undevelopable?
That's a good question. So this one here, this one. It's kind of a complex situation, but it's quite elementary. The job of the greenfield residential land industry, subdivisions, is to provide housing at an affordable price point, right? To do that, you need land to build on. To get the land to build on, you need the governments to zone it or approve it. Now, this 89,000 blocks of land is already approved by local planning, already approved by local government, and is sitting in those active estates. Like Yarrabilba, right, will have maybe 9,000 lots in their project to come. It's already been approved. This other 85,000 is in zoned areas where the state government says development can take place, but how much of that actually can be developed in terms of overcoming nature, overcoming infrastructure, floodplains and all of that. Obviously, I'm assuming 100% of what the government says can be built on will be built on, but in reality it'll probably be about 60 to 70%. And the reason why is because you need to get, well, Andrew could say, it's very hard to acquire land as a developer to build on it, because you've got to deal with multiple owners, and you've also got other issues such as infrastructure or nature. So I've assumed a very best case scenario that every square metre of land will be translated. So it's a more conservative approach. More than likely, for example, in the Gold Coast, they have a large allocation of land, but in reality it's about 40% of that is actually developable. What that means in terms of the market is that getting new land supply to deliver new projects is going to be harder rather than easier over the coming years. With that in mind, it will make anyone with a project or with land supply already in the market probably in a better position. It's going to be harder to get the land supply unless the state government rezone.
So the future, with the future balance, we are talking about 85,000 lots to be provided. Years demand is 17 years.
Yep.
If we average that out, we are talking 5,000 lots every year. Is that how I'm reading it, or am I reading it wrong?
It's the 17 years of demand is for these two.
89 plus 85.
Yeah. So it should be close to 10,000 or something, 8,000, 9,000.
174.
So if you go here, this is your annualised demand.
10,000 something,
Yeah. So over the next 2 years, annualised demand is around 8,700, according to me. 10,000. So that number, you're asking good questions. So that 17 years of demand is those two. Future projects can only come from this one, because that's 282. That's assuming 100% conversion into projects. And 282 projects based on trend would be delivered over 4 years.
But the supply balance of 89 is just up till now, or are we talking for next 17 years we have a supply balance of 89,000? Yeah.
That one, 89,000, is
What's currently approved.
yeah,
Is what is currently approved
within an active trading estate.
for the period of
Well, however long
Currently
it takes to
approved
sell.
or zoned, probably not approved.
So, like if you have a subdivision and you release, say the subdivision is 500 lots,
yeah,
a land estate might have only sold 100.
yeah,
It's got 400 left.
still
It sits in there.
right.
Yeah. Yarra Bilba has sold, I don't know, 2,000-3,000 or something, right? But it's got 10,000 remaining. Sits in that.
Correct.
Yep.
So this is just for the approved ones. So I'm saying 156 active estates still have 89,000 more lots to go.
And if you worked on, if that was the only supply in the market, 10,000 lots per annum is demand, that would be around about 8 to 9 years of demand,
Right.
right? But they've got this other supply balance where new projects are coming in,
5,000.
which will add another 8 years, assuming it can get through planning and all that stuff. And then this one here actually breaks it down by sub-market. So that supply situation is here. Like for example, Moreton Bay, we'll go to Logan. Logan has 30 years of demand covered within its supply profile. It has enough unused supply to deliver 6 years of replacement projects. And those projects will be able to address 95% of the demand target. So there'll be enough capacity. So that just gives you a little bit more detail there. But you can have a look at Gold Coast. 16 years of demand coverage, but that's assuming 100% of their land supply is good to go, which it's not.
There is no lack.
Yeah, but I'm giving you the best case scenario. Replacement projects, after 4 years, Gold Coast cannot bring on any new major residential land subdivisions. And don't worry about that one. So that's an interesting one. 120%, 3.5 years in Moreton Bay. So Moreton Bay's got a real supply issue as well. It's only got 9 years of coverage, so it can respond to customer demand for 9 years. It can bring on replacement projects for 3.5 years, and then it needs some new land supply. It'll find it somewhere, or it'll go into infill, it'll go into medium density, it'll do something.
So would sunshine be an issue as well with the capacity of 200%?
Yes. So the issue here is that 16 years, so Sunshine Coast can address 16 years worth of normal customer demand, but it can only bring on replacement projects for 2 years. And that means the projects that are currently in the market will be having to sell more land to meet the customers. That means 200% capacity. That means that the industry is probably selling 100% more than what it needs to sell to keep up with demand.
Selling one house twice, I guess.
Could do that.
To quantify like our contribution, we've got about 2,000 lots in our pipeline, of which about 500 approved and 1,500 aren't.
These metrics, when you're looking at them, like from a research point of view, you look at them in terms of proxies, like degrees of influence. So this one's a low 2 years. That means that it's going to be really hard to find new projects to come into the market. It might be longer than 2 years, but the whole point is that it's going to be very tough. This one down here, 3.5 years, 4 years. Logan is the best one, 6 years. Right? So Logan, compared to Sunshine Coast, has greater capacity to bring on replacement projects because obviously it's got a bigger land supply. Yeah.
Sorry, what is the, can you explain how the percentage is calculated?
This one, the capacity is when the number of customers, say there's 100 customers wanting a block of land, but the projects can only sustainably sell 50. So it's a 200%. So 100% means that the projects which are operating have a sustainable production capacity to meet the customers who need the house. Therefore, price growth, upward and downward movement on price is pretty stable. These ones here, so the customer demand will exceed the industry capacity by 20%. Doesn't mean it won't be met, it just means the developers will have to sell above what they would normally sell to meet it.
So in many instances you'll be selling a lot earlier for the delivery of the land to happen downstream. So there's a lag.
Yeah. Like for example in Melbourne, one of the things, when more customers come into the market in Melbourne, like say I'm a land developer, I would normally sell 20 blocks of land per month because I've got bulldozers and civil engineering making those 20 blocks of land. And it takes so long to make it, you can get the stamp through council, right? But I've got 100 people at my sales office wanting to buy. So what do I do as a developer? Do I say, look, I can only sell 20 and the other 80 customers go away? No, in Melbourne what happens is I'll sell 100, but you 80, you have to wait 3 years to get your block of land. So it's a long settlement timeline. In Queensland, they don't do that as much. Correct me if I'm wrong, Andrew.
It's not as prevalent.
Yeah.
And the sunset dates in Queensland are 18 months, whereas in Victoria they're 36.
Yeah. So Queensland's developers have tended to say if there's like 10 customers at my door and I only have 2 blocks of land, they'll say, look, I might sell 4 blocks, but you other 6, you'll have to come back another day. I'll put you on a mailing list or something. Because they have tended not to sell on extended settlement timelines.
But that's in a favour of an investment perspective, because as an investment, I would rather settle on it later.
Assuming it's going up in value, yes. Yep.
In a rising
Which averagely is
Yes.
the case, right?
Yep.
Yep. So what happened in Melbourne in 2019, 2018, there were long settlement timelines. People bought on the rise and they bought a nominated contract, right? But when the market did turn in values, it took several years for Melbourne to actually recover those values. So actually prices in Melbourne went overvalued, the housing market turned, and then land values spent, I think, 3 years moderating and another 3 years getting back, right? So
I think it's dependent on the suburbs. My experience was the opposite. However, not questioning. Yeah, again, depending on the suburbs. I guess.
that's right. So you just got to be mindful of when you.
Yeah.
But in Melbourne, they did that a lot.
Yes.
Yeah. And Sydney.
You cover the supply for Southeast Queensland. Do you see sort of in the future other councils will be considering Southeast Queensland? But we know there's other hotspots like Toowoomba or Hervey Bay. Do you think those demand once the supply sort of slow down and then people like those areas will become popular?
So the question is, will other regional markets benefit from a slowdown in supply in the traditional areas? And the answer is, well, you would have to think yes. To what degree, I have no idea. But it also depends how connected it is to the Brisbane metropolitan area as well. Theoretically, you would have to say it would be an improvement if land supply in Brisbane dried up, because that's what happened in Melbourne during COVID. and then the regions actually picked up quite a significant amount. But there would have to be a strong signal by the state planning department that they're not doing any more supply in the traditional areas. Yeah.
And there's also, I guess, a point around the UDAs in southeast Queensland. So you've got Caloundra South, which is around 40 years worth of supply, if they moderate and average it out. You've got Greater Flagstone, which is about 40-year development of land. You've got Park Ridge, which is around 35, 40 years totality. And then you've got Yarrabilba on its own out there in Logan as well. So you've got four major, Ripley Valley is another one that's around 40 years worth of supply. They're all around 3 to 5 years, 10 years into their project life cycle. So in southeast Queensland, the major UDAs have got around another 25, 30 years in there to sell out. It'd have to be an extreme market to bring that forward.
All good? So, yeah, I'll summarise again. The greenfield markets have gone through a spike. That spike was generated by the governments and COVID. It was universal, it affected everything and overvalued everything and sent developers and builders into a frenzy. We are now paying the price for that economically. Higher inflation, longer wait times, uncertain construction cost, rising lending rates. That has now put an end to that strong period of selling, and we're at the bottom of the cycle. Every market's at the bottom. It is now a slow but considered move back to average. And the pathway back to average will be influenced by what the Reserve Bank does now. But it will not remove the fact that people, more and more people, off a low base will be needing more housing. It's just whether they can afford it or they feel comfortable enough in doing it. So that's going to be the major influence over the next 6 to 18 months, I reckon. Yeah.
Okay, we'll wrap it up there. Thanks everyone for your questions as well, and thanks for your attendance, and thanks to those people at home for tuning in, including a couple of questions we got. That concludes our Q&A, and we'll, for those of you hanging around, we'll step next door and enjoy a nice dinner. So thank you.